The world order we once knew is crumbling before our eyes. What started as routine trade discussions has morphed into something far more dramatic, a full-blown geopolitical theater. Scott Bessent touched down in Malaysia convinced he held all the cards. Instead, China's representatives showed up ready to prove that Washington's influence isn't what it used to be. Meanwhile, President Trump continues cranking up the economic pressure, issuing demands that seem increasingly detached from global realities, as though American threats still command the fear they once did. From the corridors of power in Beijing to the government offices in Ottawa, a unified signal is emerging. Nations worldwide are refusing to follow America's playbook anymore. Financial markets are responding with volatility. Exchange rates are fluctuating wildly. And precious metals, particularly gold, are sending distress signals that veteran traders recognize all too well. This turbulence feels hauntingly familiar, yet somehow more profound than previous crises. Trade barriers, energy politics, and international partnerships have become hopelessly entangled. The balance of power is reorganizing at breakneck speed, and each decision coming from the White House seems to accelerate the world's departure from the stability it once knew. This is where we begin our investigation today, with Bessent confronting Chinese negotiators and with Washington slowly coming to terms with a disturbing possibility. America may no longer control the game. When confidence meets reality, Malaysia becomes a turning point. Scott Bessent stepped off the plane in Kuala Lumpur carrying more than just briefing documents. He arrived with confidence, some might say overconfidence. Intelligence circulating through Washington's inner circles suggested that American complaints had successfully removed a senior Chinese trade official from the negotiating team. The implication was clear. Beijing was rattled, perhaps even vulnerable. But when the conference room doors swung open, reality delivered a different message entirely. There sat the very official Bessent expected to be absent, composed, dressed entirely in black, positioned directly across the negotiation table. His presence spoke volumes without a single word being uttered. Beijing's message came through crystal clear. American pressure tactics don't intimidate China's trade warriors. For Chinese negotiators, this meeting represented just another chapter in what they view as the ultimate contest of economic endurance, a marathon test of national willpower with stakes higher than any Olympic competition. Bessent's team arrived prepared with America's traditional arsenal threats of escalating tariffs, promises of relief in exchange for compliance, and the implicit suggestion that resistance would prove costly. But something fundamental had shifted. The leverage Washington once wielded had evaporated. The United States came to the table offering nothing substantive, merely agreeing to remove penalties it had imposed unilaterally in the first place. President Trump continues deploying the same playbook he's relied on for years: maximum pressure, punitive tariffs, and aggressive posturing. Yet an interesting pattern has emerged. The louder Washington becomes, the quieter Beijing responds. Where American officials raise their voices, Chinese counterparts lower theirs, speaking less frequently but with greater precision and strategic calculation. Inside that Malaysian conference room, the power imbalance was palpable to anyone paying attention. The American delegation wanted everything on their wish list: dramatically reduced Chinese tariffs, massive increases in American product purchases, and Beijing loosening its grip on strategic industries. In exchange, they offered virtually nothing of real value, just the promise to dial back their own punitive measures. China's strategy, by contrast, demonstrated sophistication that comes from playing the long game. They understand something Washington seems to have forgotten. In negotiations of this magnitude, patience becomes the ultimate weapon. Beijing's approach is simple. Watch Trump's advisors argue among themselves, allow internal contradictions to surface, and let American frustration do the heavy lifting. The atmosphere grew increasingly theatrical as hours passed, with both delegations performing for audiences beyond the room. But the underlying truth became impossible to ignore. This wasn't genuine negotiation anymore. It had transformed into an endurance test, a battle of wills to see which side would crack first. And despite Besant's attempts to project confidence through forced smiles and carefully chosen words, one reality was already becoming apparent to observers on both sides. The United States had entered a competition where the rules had fundamentally changed, and Washington no longer wrote those rules. Trump's ultimatum, a proposal built on quicksand. President Trump entered these latest negotiations carrying what his team presumably considers bold demands. Though, to outside observers, the list reads less like a serious trade framework and more like wishful thinking drafted under extreme time pressure. His administration is proposing a tariff structure that seems almost deliberately lopsided. 30% duties on Chinese goods entering America, while accepting that Beijing would maintain its own tariffs at merely 10%. From Trump's perspective, this asymmetry isn't a concession, it's leverage in action. As he explained in his characteristic style, "As you know, they're paying 55%. That's a lot of money. They never were paying anything over years and years and years. But they were like anybody else. A lot of countries took advantage of the U.S. They're not taking advantage anymore. China's paying 55% and a potential 155% come November 1st unless we make a deal. And a meeting with President Xi, we have a very good relationship." Trump repeatedly emphasizes his November 1st deadline, warning that Chinese tariffs could skyrocket to 155% without an agreement. His words oscillate between swagger and anxiety, projecting strength while simultaneously revealing concern about whether his threats will actually work. The fundamental problem? The mathematics don't align with economic reality. Every new tariff wave doesn't primarily punish China. It adds costs that American consumers and manufacturers ultimately absorb. Behind Trump's public declarations lies a sprawling wish list that reveals just how much Washington wants from Beijing. The demands include forcing China to lift restrictions on semiconductor technology, allowing Dutch company ASML and Japan's Tokyo Electron to resume selling cutting-edge lithography equipment to Chinese manufacturers. Trump wants China to end its export limitations on rare earth elements, materials absolutely critical for American defense contractors producing advanced missile guidance systems. His team is demanding Beijing tighten controls on fentanyl precursor chemicals flowing toward North American drug markets. They want China to resume purchasing American soybeans in quantities large enough to rescue struggling Midwestern farmers whose markets collapsed under previous trade war disruptions. But the most audacious demand, and potentially the most explosive, involves energy geopolitics. Trump is insisting that China completely cease purchasing Russian oil. For Beijing, this crosses into non-negotiable territory. Trump frames this demand as a strategic masterstroke, cutting off Moscow's revenue stream, isolating Vladimir Putin economically, and forcing Russia to reconsider its international positioning. But China views this entirely differently, as Washington attempting to dictate Beijing's sovereign energy policy and trying to sever a partnership that's become economically vital. Abandoning Russian oil would mean surrendering a strategic lifeline. We're talking about affordable, reliable crude that keeps Chinese industrial machinery running and prevents domestic inflation from spiraling out of control. Trump's approach demonstrates how Washington continues attempting to exercise dominance through economic coercion, wielding tariffs and trade restrictions like weapons of statecraft. But the global landscape has transformed fundamentally since America last held undisputed economic supremacy. China no longer negotiates from weakness. Beijing has spent decades building alternative partnerships, developing domestic industries, and creating economic resilience that can withstand external pressure. Each new American demand paradoxically pushes the two powers further apart, rather than bringing them together. What started as trade negotiations has evolved into something more profound, a fundamental contest over who gets to establish the rules governing global commerce for the next generation. Among all of President Trump's conditions, one stands out as fundamentally disconnected from geopolitical reality: his insistence that China abandon Russian oil entirely. On paper, this might appear clever, a calculated move to drain Putin's revenue sources and undermine Moscow's war machine. In practice, it amounts to asking Beijing to voluntarily destroy one of its most strategically valuable and economically beneficial energy relationships. Let's examine the numbers, because they tell a story Washington seems unwilling to acknowledge. China currently purchases approximately half of all Russian crude oil exports. These shipments account for roughly 20% of China's total imported oil, a massive share of the fuel powering the world's second-largest economy. Without Russian supply, Chinese industries spanning plastics manufacturing, fertilizer production, gasoline refining, and countless other sectors would face immediate shortages of affordable feedstock. The financial mathematics are equally compelling. Russian crude oil departing from Baltic seaports sells at a $12 discount compared to benchmark Brent crude. It's at least $10 cheaper per barrel than supplies from most alternative global sources. For Beijing's economic planners, this price difference isn't merely about saving money in government accounts. It represents economic stability itself. These discounted Russian barrels keep Chinese refineries operating profitably and allow factories to maintain competitive pricing, even as Western sanctions attempt to reshape global energy flows. Since the latest round of international restrictions took effect, oil prices have already climbed more than 7% across global markets. This price surge makes Russian shipments even more financially attractive to Chinese buyers. Beyond economics, there's a clear logistical advantage that makes this partnership difficult to replicate. Russia's eastern ports connect directly to Chinese infrastructure through the Eastern Siberia-Pacific Ocean pipeline, which already operates at maximum capacity. Oil tankers travel relatively short, low-risk maritime routes straight into Chinese refineries clustered around industrial centers like Docking and Dalian. Shipping costs remain minimal. Insurance is handled domestically, avoiding Western companies that might face political pressure to deny coverage. And supply reliability is exceptionally high. No Middle Eastern political volatility, no Hormuz Strait choke points, no dependency on sea lanes controlled by the U.S. Navy. For China's strategic planners, this arrangement represents the perfect formula. Geographically close, financially cheap, and politically secure. Walking away from this setup would trigger both immediate financial damage and long-term strategic disaster. It would shatter Beijing's carefully constructed energy security framework, drive up domestic manufacturing costs across entire industrial sectors, and destroy the trust China has methodically built with Moscow over decades of partnership. And in exchange for this self-inflicted wound, Beijing would receive what exactly? A temporary promise from an American administration whose policies might completely reverse after the next election cycle? From a practical enforcement standpoint, blocking this trade physically borders on impossible. Any American attempt to intercept Russian oil tankers navigating toward Chinese ports would risk direct military confrontation between nuclear-armed powers, a line even the most hawkish Washington strategists won't cross. So while Trump continues demanding that Beijing choose between Washington and Moscow, China has already made its choice. It's choosing long-term energy security over short-term diplomatic pressure. It's building an energy alliance specifically designed to withstand Western sanctions and political coercion. The United States characterizes this as defiance. China considers it pure survival, a rational decision by a major power protecting its core national interests. And the more Washington escalates its demands, the stronger and more resilient this Beijing-Moscow energy partnership becomes, gradually constructing what amounts to a parallel global economy operating beyond Western control. Trump's demand that China stop purchasing Russian oil has created an unintended consequence that should concern Washington's strategists far more than Beijing's. the rapid expansion of a sophisticated global shadow economy. Instead of halting trade, American sanctions have simply pushed it underground, creating networks that are harder to monitor, impossible to regulate, and increasingly profitable for everyone involved except Western regulators. Russian oil continues flowing toward Asian markets in enormous volumes. It's just no longer traveling through channels that appear on official customs documents. Major Russian energy companies like Rosneft and Lukoil have transformed sanctions evasion into a refined science. They've mastered the art of selling to intermediary firms and shell companies that expertly disguise crude oil's true origins before it reaches final buyers in Asia. The names on shipping manifests and invoices change hands multiple times, but the actual oil remains identical. Within China, both state-owned petroleum giants and private refining operations participate in this elaborate dance. They've learned to shuffle import orders through smaller, less prominent buyers, entities that industry insiders now refer to as dark refiners or teapot refineries. On official paperwork, these shipments appear to originate from Malaysia or Singapore, passing through legitimate-seeming supply chains. In reality, they're the exact same Russian barrels, simply rerouted through what energy analysts have begun calling the shadow fleet. This floating network of tankers operates with minimal oversight and maximum flexibility. Vessels frequently disable their transponder systems, making them invisible to satellite tracking. They change registration flags mid-voyage, switching national identities to avoid scrutiny. They offload cargo at ports where local authorities either can't or won't ask uncomfortable questions about provenance. The profit margins generated by this system are staggering. We're talking about billions of dollars earned annually. The business model is straightforward: purchase cheap Russian crude, blend it with oil from other sources, rebrand the mixture, then sell it at standard global market prices. The margins are extraordinary because the Russian component costs significantly less than equivalent grades from the Middle East or West Africa. Every time Washington implements new sanctions or tightens existing restrictions, another alternative pathway emerges somewhere in the global trading system. Close one loophole in Southeast Asian waters, and 3 new routes open through Central Asian pipelines or South Asian ports. It's become exactly what one frustrated American official privately described as a never-ending game of whack-a-mole. The United States strikes one vulnerability point, celebrating a tactical victory, while the system adapts and reconstitutes itself through 3 different channels before regulators even file their reports. For China and Russia, this chaotic arrangement works surprisingly well, perhaps better than a more transparent system would. Energy continues flowing reliably, money keeps circulating through the partnership, and Western compliance officers are left perpetually guessing about the true scale and routing of transactions. The sanctions designed to isolate Moscow and pressure Beijing have instead created a hidden trade network that's more dynamic, more creative, and more resilient than the official system it replaced. And as this underground marketplace expands in scale and sophistication, its scope has grown far beyond petroleum. It's evolving into a parallel trading system for everything from agricultural commodities to manufactured goods. Proof that economic survival instincts will always find pathways around political obstacles. Meanwhile, the ripple effects of Trump's aggressive trade posture have begun reaching beyond Pacific rivals, now striking America's closest neighbors and oldest allies. President Trump's trade confrontation is now spreading northward with unexpected severity, straining relationships that both countries have long considered unshakable. The trigger was almost absurdly minor. Canadian media aired a patriotic advertisement promoting domestic economic independence. A lighthearted campaign that drew stylistic inspiration from Ronald Reagan's famous Morning in America messaging. The ad celebrated Canadian resilience and self-sufficiency without directly criticizing American policy. Trump, however, reportedly interpreted this as a personal affront and a rejection of American leadership. His response came swiftly and severely. an additional 10% tariff on Canadian imports, raising the total tariff burden from 35% to 45%. What might appear to observers as symbolic punishment could soon trigger serious economic damage throughout North America. Canada ranks as the United States' second-largest trading partner, with deeply integrated supply chains spanning automotive manufacturing, energy production, agriculture, and natural resources. Tariffs at this level threaten to freeze cross-border commerce and drive up consumer prices across both nations. Inside Ottawa's government offices, the reaction mixed shock with profound disbelief. Canadian officials had operated under the assumption that their historically close relationship with Washington, fortified by defense treaties, intelligence sharing, and cultural ties, would provide insulation from Trump's most aggressive trade measures. They were wrong. The economic impact is already manifesting in hard data. Canada's GDP per capita has been declining steadily since 2023, and the rate of decline is actually accelerating through 2025. Productivity growth remains anemic, business investment is sluggish, and the federal government's fiscal deficit is now projected to exceed 2% of GDP, a level that reduces Ottawa's flexibility to respond with stimulus measures. To survive what increasingly looks like economic warfare with its largest trading partner, Canada needs new export markets and new sources of investment capital urgently. Prime Minister Mark Carney is now personally leading diplomatic outreach missions throughout Asia, targeting partnerships with China and the Association of Southeast Asian Nations Economies. As he explained during a recent trade mission, what we can also control, or at least heavily influence, is developing new partnerships and opportunities, including with the economic giants of Asia, which is the focus of this trip. The strategy couldn't be clearer. If it were painted in neon: sell more Canadian oil and natural gas to Eastern markets, attract Asian infrastructure investment and manufacturing partnerships, and systematically reduce economic dependence on unpredictable American trade policy. This realignment plan includes significant expansion of Western Canadian pipeline infrastructure, specifically designed to redirect energy exports away from American buyers and toward Pacific shipping routes serving Asian customers. But this geographic and economic pivot carries substantial risks that extend beyond commerce. Every step Canada takes away from Washington deepens political tension in a relationship that has survived nearly every previous challenge. Every new commercial agreement signed with Chinese or Southeast Asian partners threatens the delicate balance that has kept North American trade functioning smoothly for generations. Trump's tariffs were presumably intended to project American strength and force trading partners into submission. Instead, they've revealed just how fragile America's network of alliances has become when subjected to sustained pressure. As Canada actively courts Asian partnerships and redirects its economic orientation eastward, investors worldwide are watching this realignment closely, and so are global financial markets, which are once again turning toward humanity's oldest refuge during periods of uncertainty and instability. While politicians trade threats and economists debate tariff impacts, one asset class has emerged as the clear beneficiary of global chaos: gold. After an extraordinary 50% price surge over the past 12 months, the precious metal finally experienced a correction. And contrary to what nervous investors might think, this pullback represents a healthy development. No asset should rise that dramatically without periodic consolidation. Markets need breathing room, and gold is no exception. Professional traders are monitoring several key indicators closely. Options data from the COMEX exchange reveals that interest in gold put options, essentially bets that prices will decline, has reached the highest levels recorded since 2019. Hedge funds and speculators are actively positioning against gold, building short positions that would profit from falling prices. But here's what makes this interesting. That bearish pressure is precisely what keeps the market structurally stable. If gold prices manage to hold steady or even advance despite heavy short positioning, it signals genuine underlying strength rather than speculative froth. Major financial institutions are increasingly turning bullish on gold's long-term prospects. JP Morgan's commodities research team now forecasts gold reaching $5,000 per ounce by 2026, with potential to touch $6,000 by 2028. Their analysis points to two primary drivers: continued central bank purchases across emerging economies, and a gradual but persistent shift by international investors away from U.S.-denominated assets. The reasoning behind this institutional bullishness is straightforward. Confidence in the American economic system is eroding at the margins. Consider the fiscal data. The United States federal deficit currently stands at approximately $1.8 trillion, barely $8 billion lower than the previous year's shortfall, despite robust economic growth. Government spending has actually increased by $220 billion, and interest payments on the national debt have climbed by another $80 billion annually.